What's up, you guys? I'm Dan, this is Frugal Not Cheap, and today we'll talk about the collapse of the $60 billion in the Terra and Luna cryptocurrencies and the state of the crypto market. So what's happened? Well, a stablecoin with a market capitalization of as high as $18.6 billion called Terra and an associated cryptocurrency called Luna that had a market cap of as high as $41 billion have collapsed. Look, I firmly believe that one should understand what they're putting their money into before they put their money in. So last year I put together a video on Bitcoin. This is a fairly cursory dive into cryptocurrencies in general, but specifically about Bitcoin, because of course cryptocurrencies come in many flavors. However, I do encourage you, if you're interested in the crypto space at all, to watch that video. Many of sort of the take-home findings about Bitcoin are broadly applicable to the overall crypto market as well. Should be no surprise to you if you've seen that video that I have none of my own personal money in cryptocurrencies. And that's not to say that I don't recognize that, of course, some people have made some money, and in cases tremendous sums of money in this space. But it's certainly not for me, as it's highly speculative and full of fraud. And I think really the collapse of Terra and Luna is quite instructive in pointing out sort of these flaws with the cryptocurrency market as it stands. Now, I don't think that digital currencies are completely without any kind of value. There was a coin, a project backed by Facebook that was called the DM project. So this was a project for a stablecoin that would be actually indexed to a basket of currencies that would have an immediately a large reach, as you know, there are billions of users amongst Facebook's various companies, Instagram, WhatsApp, etc. So this coin also addressed many of the problems that are associated with cryptocurrencies, many of the ones that were the downfall of Terra and Luna, and continue to be issues, the way that I see it, with really all cryptocurrencies out there, Bitcoin and Ethereum included, even though these are, of course, pretty huge in terms of their current market cap. Unfortunately, however, due to regulatory pushback, even after the Libra coin was rebranded as DM, it was completely unsuccessful, and they eventually threw in the towel. So what I'd like to do in today's video is talk a little bit more about cryptocurrencies within the framework of talking about Terra and Luna, just to give you a little bit of a cursory idea of how these things work and what's going on, especially since this was a pretty big crash. And then we'll look at the broader crypto market in general and kind of look at my thoughts on that as well. So my hope is, again, just to educate you a little bit about cryptocurrencies, and then hopefully to give you some pause to do more research before you think about throwing money in there, especially if it's money that you can't afford to lose. Well, I guess we should begin with the features of the current traditional banking system that cryptocurrencies are meant to address. So this is, kind of why. Well, what is the why for the Terra stablecoin? And really for cryptocurrencies in general. So one of the big attractive benefits of it is a certain level of privacy or anonymity. And this is something that's not really well understood. So the idea is that, of course, the end owner behind the wallets that are transacting are anonymous. However, all of the transactions are publicly available on the ledger. That's the whole idea of the blockchain. And so through forensic accounting, it is, of course, possible to figure out who the owners are. Famously, with the case of the ransomware of Colonial Pipeline, that was paid for in cryptocurrencies and Bitcoin, and they were able to find who they were and to reverse a lot of that, not on the blockchain, but in order to get the money back anyway. And so clearly we saw there that it's not really as anonymous as we'd like to think. But that is the idea behind cryptocurrencies, is that they're supposed to provide some level of anonymity, or at least privacy, although again, sort of wallets and any transactions that are involved with those wallets are publicly available, because of course the blockchain is meant to be publicly available. That's the whole point. That's the main way that decentralized finance, which is the other main selling point perhaps of cryptocurrencies, is meant to be. So whereas right now with fiat currencies we have government and central banks issuing currency, right? And then we have, of course, all of these financial intermediaries that are involved in all the transactions, and so things are in a way sort of centralized, right? And then the idea behind many cryptocurrencies, they all have varying degrees of centralization, right? We'll have to say. But the idea is that a lot of the work of updating the blockchain can be done by really any machine that's hooked up to the blockchain, at least in the case of Bitcoin, for instance. In other applications, there's different levels of centralization where you might have different nodes and what have you. But in essence, that's kind of the idea, that this whole system can live peer-to-peer on a decentralized network, and so it doesn't have this central point of fault, and it also doesn't have a central point where people can decide whether or not a transaction is legitimate, which is the other selling point, is that this is a permissionless system. In other words, you can just get a wallet and go in and transact without having to do all of the pesky know your counterparty, proving that you're a legitimate actor and that you're not laundering money and all this kind of stuff. Really a way to try to sidestep both regulation and taxation. And then also, of course, avoiding fees, which might be perhaps the most legitimate driving factor behind cryptocurrencies, is to try to transact things costlessly or at a much lower cost in terms of remitting payments to family and friends and what have you across borders. If I were a criminal or a money launderer, of course, all of this would be much more attractive. Or if I was extremely paranoid about privacy and my information, that kind of thing, this can also seem attractive. That's kind of the nice thing about cash, of course, is that cash doesn't leave a trail in the same way that online banking and digital banking transactions do, and that can be attractive to people that, again, have these major concerns about privacy and the man and all this kind of thing. Yeah, for me, I don't really care. Now, does that mean that I necessarily want all the transactions that I've ever done in my life to be put on a centralized server and made publicly available somewhere? No, I wouldn't like that, but that isn't the case of the current banking system anyway. So that's kind of the idea, and that was kind of at least sort of the marketing of the dream behind Bitcoin. But obviously, with an asset as volatile as Bitcoin, this thing's price has gone crazy, right? From just pennies to dollars to as high as $60,000 at some point. And this is not something that can be very well used in order to conduct transactions, right? And so that's why, of course, stablecoins were developed, things where the value would be more stable, and we could actually potentially use these things for transactions, or at least as a place to go as an intermediary between transactions from one cryptocurrency to another, so that we wouldn't have to, in between of selling my Ethereum, for instance, and then wanting to buy Bitcoin or Doge or something else, I wouldn't have to go back out to the traditional banking system. I could go to an intermediary point, a stable coin, and then from there on to another. Now, the irony, of course, is that these are coins that are stable relative to a fiat currency, the very thing that they're meant to replace. In today's case, we're talking about the Terra US dollar coin, or UST. And so this was meant to hold its value a peg of 1-to-1 against the US dollar. So that already says something about the whole argument that, oh, fiat currency is only vapor, and I don't know. There's all these crazy crypto stuff that really diehard crypto people will talk about, and yeah, I understand philosophically where they're coming from, but I think also they're completely missing the boat in terms of practicality and what's actually feasible out there. Anyway, so there are many stablecoins out there. Doquan and others in this Terraform Labs project, so-called project, put out the stablecoin called Terra. Of course, Terra meaning earth, right, in Latin. And then the idea is that it would be hooked up to another coin called Luna, which would be allowed to fluctuate in value, but where an algorithm would control supply in order to ensure that the peg of Terra to the US dollar would be maintained stable through arbitrage. In other words, this was what's known as an algorithmic stablecoin, where an algorithm is the basis upon which its value is derived, where, again, supply and demand is managed so that the one-to-one dollar peg is maintained. In other words, there's always an arbitrage opportunity present. So if Terra manages to go below $1, because it is always redeemable for $1 worth of the sister or associated cryptocurrency called Luna, then you could always redeem that and get your money back and then plow it back, and so on and so forth. And so there's always any kind of arbitrage opportunity that might be presenting itself would cause actors to go in and then, by taking advantage of the arbitrage window, then narrow that window and eliminate it. That idea sort of sounds sound. The problems come with what happens on the other side, on the Luna side. And we'll get into this architectural flaw a little bit later. This is something that anyone could have seen coming, and in fact its creator definitely saw coming, in my view.
It's a cycle of life. You begin from nothing and go back to nothing. And that's exactly where I want to be. So I think Terra is going to be the decentralized money standard across the entire blockchain, across all the blockchains. And I'm excited for Terraform Labs to contribute a significant portion of that early vision, but eventually to go back to nothing.
Right.
Yeah. Excited.
But in any case, their goal was to get this Terra coin to have some kind of widespread adoption and, change the world, blah, 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 just like all of the cryptocurrencies are supposed to, right? Yeah. Or actually, in many cases, they're just fraudsters that want to run a pump and dump and, want to get rich quick, right? But anyway, so with this Terra, the way that its widespread adoption was encouraged was by providing a 20% yield on deposits. This is a ridiculously unsustainable yield, right? But of course, they said that this was, they knew it was unsustainable and they were going to do this for some time in order to get kind of its legs under it and have widespread adoption. And they're, in the future, then they'd be able to reduce this yield or completely eliminate it or what have you. Now, of course, we never got to that point because the whole thing collapsed. Now, why did it collapse? Well, again, this was due to an architectural flaw. The arbitrage between Luna and Terra, and thereby maintaining the peg for Terra, only works so far as Luna maintains some value. Now, where was the value of Luna coming from? Well, of course, there was a liquidity pool of all these people people put money into it. And of course, that market capitalization and the value of Luna did rise as people bought into this whole system. However, when people started to pull out of the system and the value of Luna started to fall, then the problem is that the same arbitrage mechanism to peg the value of Terra meant that more and more Luna were being issued. And of course, more and more Luna were being issued at less value. And so the more and more this happened, then the more it created what's essentially a death spiral. This was described very well, I think, by Patrick Boyle in his video on this subject, where he talked about fixed value bonds, where you'd be able to redeem them for X dollars of value of X dollars worth of the company's stock. This sort of last ditch attempt to save a company. And of course, it never works. And the same thing, as he pointed out here, it did not work at all for this algorithmic stablecoin or for any other algorithmic stablecoin that's ever been issued, by the way. And of course, this spiraled down into nothingness. So let's put some numbers to all this. The Terra stablecoin depegged on May the 8th. It had been stable since at least November of 2020. I think that's when it was issued. But its price has dropped from $1 to just 6 cents. And again, that market cap of $18.6 billion that it had at its peak had fallen to around $665 million. Now, why people would still be putting money into this thing, in its death throes is beyond me. And of course, there are these efforts by the people behind it to, fork and continue and do different things. But hopefully if you're watching this video, you're not one of the people that's considering doing that. Now, as far as Luna, its price dropped from a high of $116.41 back on April the 3rd to essentially zero on May the 12th. And again, people were thinking about putting money back into Luna at this point, thinking that, if its value recovered to, even just a little bit, that it would be worth a lot, without noticing that, of course, again, more and more Luna were being issued at lower values in order to try to maintain this Terra peg. And so now on a monetary base adjusted basis, you'd have to have, it's just not going to happen. So that's what happened with Terra and Luna. Why did it happen? Well, there's been, of course, a broader sell-off in crypto assets since sort of some highs last year. This has to some degree, at least this year, coincided with really a risk-off kind of environment as yields are rising on treasuries, as the Federal Open Market Committee starts to they're unwinding the size of their balance sheet, and they've been raising interest rates. And so as the risk-free rate rises, then of course risky assets become increasingly less attractive. And so this flight to safety has been one issue. Also, I think it's pretty clear that things were pretty frothy and bubbly during the pandemic period, as we saw very high price-earnings ratios, money going into SPACs and a bunch of nonsense that really didn't have any value. And to me, that included things like NFTs and cryptocurrencies as well. So there's been a sell-off in Bitcoin since some highs back in November of last year, where it was trading at around $64,400. It fell all the way down to $40,000 on May 4th. And then perhaps accelerated to some degree by the collapse of Tether and Luna. Then it went on to fall to less than $29,000 on May the 18th. Why might it have accelerated due to this collapse? Well, one, obviously, there's been a real shaking of the confidence within the whole cryptocurrency ecosystem, right? So I think that's certainly a contributor. Also, more directly, though, the Terraform Labs and Do Kwon had set up something called the Luna Foundation Guard. This was essentially some reserves in Bitcoin and Ethereum and other cryptocurrencies that were meant to be used as sort of a backstop in case there was a sell-off in Luna. And in fact, they did sell off $3 billion worth of Bitcoin. And so, of course, that sell-off would have contributed to the drop in Bitcoin that we saw to some degree. And then other assets, and really most of that reserve has been sold off. And exactly what's happened with the proceeds of those sales, I think, is a very interesting point that should be looked at, right? So we can see, I don't know if anyone's done the forensic accounting yet on kind of what's happened with those wallets, but I think it'd be very interesting to investigate that. And then, of course, some of it, though, in sort of a PR effort, supposedly some of the remaining assets are going to be used to help bail out some of the people that have lost their money, especially focusing on the smaller investors, which makes sense, right? You can make a lot of the smaller guys whole and please a lot, larger number of persons if you're doing that. And it also kind of has really good PR spin, right? That we're helping out the little guy. But again, this is nothing new, wanting to bail people out when they lose all their money, right? We have, in terms of the traditional banking system, after the collapse and the Great Depression and the run on banks back then, we have, of course, federal deposit insurance, right? Which is protecting your depository assets. There is also insurance on your securities as well. Of course, this doesn't guarantee you in terms of the price of the securities, but against, if something were to happen to the custodian of your shares, you would still be made whole. So that insurance exists as well. So all these things are not new. And of course, these things are not possible unless you have a central figure, the government, in order to back these assets up. So yeah, a lot of these crypto arguments sound great if people in the world didn't work the way that they did. Anyway, so Bitcoin has sold off really quite sharply, but perhaps more worrisome has been the brief depeg of the Tether cryptocurrency. So this is another stablecoin, one-to-one to the US dollar, and it underpins really a huge volume of cryptocurrency transactions. It's really a key point in crypto exchanges and in cryptocurrency, the cryptocurrency ecosystem itself. And the depeg that happened is a bit scary, and I think should really shake anyone's confidence in the whole system. Market cap in Tether has not fallen nearly as sharply as what happened in Luna, but did drop from $83 billion back on May the 10th to $73 billion. So again, it's not steep, but it is worrisome. And really is worrisome because Tether is not backed one-to-one. Supposedly they're backed by some kind of reserves which have not been audited, using GAAP procedures. And so we don't really know. We're just kind of taking their word for it. And at the times they've shown like snapshot of assets, but again, these could have, been flown in very recently and then gone back out just as quickly. They say there's commercial paper, but they've been, increasing the share of treasuries beyond that. But again, it's a little bit unclear. It's very unclear, what these assets are, what the ratios are as well, of how much of these assets there are in ratio to the amount of Tether that's out there. So, very suspect. So much so that, this could spur regulation to come, especially as if they're holding a lot of commercial paper, they're in the money markets, and they're also holding treasuries due to fears of contagion, right? That any kind of a crash here in Tether, perhaps, could then spill over into the non-crypto markets or the traditional banking sector. So, yeah, a lot to consider. I'm not sure how structured this video came out. I had a whole script and I was going to do this very structured video, but I found that it was really not genuine when I did it that way, and so I thought it was much better just to kind of give my thoughts in this manner. So if nothing else, I hope it's given you an idea about just how confidence-based crypto assets are, how much fraud there is in the space, how speculative the space really is. Even these stable coins are not all that stable, and there's significant risk there. And there's no one that's really going to bail you out if you lose all your money. So, for myself, my part, I will continue not to quote unquote invest in crypto. Again, not to say that I couldn't make any money or that someone else hasn't made lots of money in the space. People certainly have, but I just don't see the risk reward being worth it. I would much rather put my money into things that actually generate value, called companies, owning stock in those companies, or owning debt in companies and governments that have promised to pay back that debt at interest, and that we have a reasonable expectation that they're going to be able to do so, right? So bonds. So yeah, it continues to not be for me, but I do hope that some of the things that are going on in crypto, or that crypto's meant to do, I hope that kind of thing will put some pressure on the traditional banking system to step that up, increase the speed of transactions, reduce the cost of transactions, and more closely integrate the global financial system. I think all of those things would be good things to some degree, and I do hope to see that happen. But for now, again, what's going on in the crypto space specifically, I don't see any project that really has, I don't see any of the stablecoins ever, really having legs in terms of widespread adoption to be used as money. And then in terms of the non-stable coins, again, those are highly speculative, very risky assets. To, a certain degree, I do think things like Bitcoin and Ethereum aren't as ridiculous as non-fungible tokens or NFTs. And by the way, if you want to learn really kind of a deep dive into NFTs and into cryptocurrencies in general, there's a video called Line Goes Up. I'll link that in the description below, and it's a really well done project for the most part. I don't really agree with some of their closing remarks and sort of their framework for thinking about the world per se, but I think you could definitely learn a lot about crypto and NFTs if you watch this video. So hopefully you found this slightly rambling video helpful. If you did, please hit the like button and consider subscribing. Thank you very much for watching, and I'll see you in the next video.